Hi, Brent. Welcome to Venture with Grace today.
Hi, Grace. Good morning.
Good morning. So to start off the show, I want to give the audience a little bit of your background. So prior to joining M13, you were at Battery Ventures, and before that, you worked in strategy and BD for Samsung Next. And to start the show, I would love for you to share a little bit more about how you got into venture. As I mentioned, I was listening to your interview with the other podcast. Like basically, you're writing down about like you kind of your first exposure to venture capital was in college at a so at kind of like similar to like a university VC program. So like I wanted to learn more about like how you got into venture and how you kind of like created a career for yourself in venture.
All right. Yeah, let's start there. So I did my undergrad at BYU in Utah,
Mhm.
and at the time I graduated in 2013. So this was 2010, 2011 timeframe when I was looking at doing internships. That would help me set up for a good career after I graduated. And at the time, there was this group in Salt Lake City, which is about 45 minutes north of Provo, where BYU campus is. And they had a program for students to get involved in venture. It was called, at the time, it was called University Venture Fund. They're still around. They're on a couple of funds later. It's called the University Growth Fund now, if you want to look it up later.
Mhm.
Essentially, it was an internship that you did in school where you could be part of student deal teams and evaluate real companies and actually write real checks. They had, at that time, a dedicated fund. It was about $18 million. And every year they would take a cohort of students from BYU, University of Utah, and Westminster College in Salt Lake City. So every year there were about 20 to 20-ish interns that would join.
Mhm.
There were two professional managers at the time that did that as their full-time job, and it was a real VC. They had real limited partners from banks, institutions, endowments, and we got a look at a lot of deals. And so that was my first exposure to venture capital. I did that for 2 years in undergrad. And the very first investment that we made that we looked at was a business called Instructure.
Mhm.
And this was in Salt Lake. They were a competitor to Blackboard, if you know that business. Basically, software for universities and the educational system. So they were taking on an incumbent that had been around for years. That business ended up doing well for the fund. It went public. So it was a really great opportunity to learn. But over the course of 2 years, I was part of maybe 15 or 20 deal teams. I mean, we were writing small 200 to $300,000 checks. But it's that, we would diligence company for a couple months and really get deep into the weeds. And so I just fell in love with this. I grew up in Eastern Washington State. I was never exposed to venture capital there. The first time I heard about it was in college, and just loved the opportunity to meet founders, invest in startups. It was an eye-opening experience to me. And so, leaving college, it became clear that rarely did you join a VC right out of college.
Mhm.
To my surprise, that's actually the model that Battery runs. They do hire analysts out of college, out of undergrad, to source deals. But at the time, like that was a very unique thing. In most VCs, they required some level of experience. And so I went into investment banking. I did that for a couple of years in San Francisco, and then started to work at Samsung on their corp dev and strategy team, and really just understood. We made a couple acquisitions when I was there, and understood what it takes to look at a company and assess if the product fits your mandate as Samsung, if the founders would be able to add something post acquisition, and just got that muscle going of understanding what the buy side is like. And then from there, I transitioned, and my first job in venture was at Battery Ventures. So at Battery, I was part of the private equity team. We did either very late stage growth equity checks, but most of what we did was in complete buyouts. So we would acquire more than 50% of the companies. We were looking at vertical SaaS businesses, and this was the typical associate role of just sourcing and diligence. And
Mhm.
so over the course of my couple of years there, had an opportunity to cold call so many people,
Mhm.
get rejected so many times, and it just teaches you persistence. It's no wonder, if you look at Silicon Valley today and the venture landscape, the Battery alumni network is very huge. People spend a couple of years there, learn venture, and then go out into the ecosystem and start new funds or join other funds. I was actually at dinner with an LP the other week as part of the Upfront Summit, and he was a Bessemer alum, and we were just talking about how there are so many of our colleagues just spread out at other firms now, and so it was kind of fun to reminisce over that. But that was my journey into venture. It was almost a backdoor way in where I joined a private equity team, saw the both the late stage practice at Battery, and then also got to exposure to the early stage. And so that led me to I got approached by a recruiter in 2017 about a new venture fund that was starting by two co-founding brothers. It was based in Los Angeles. They were raising their first fund, and they needed a first person to join them. So I left the Bay Area that I'd been there for about 5 years. It was all I knew in my professional career, and I moved to LA. And that was 7 years ago, and the rest is history. And we've been building M13 ever since. We went from zero to now we're closing out our third fund, and we started with 3 people, and now we're over 40 offices in LA, New York, and opening San Francisco now. So it's been quite the journey of being at a startup VC and now seeing that transition from emerging manager to emerge. So I'll stop there, but that's the long way of me getting into venture and how we're talking today.
Amazing. So I want to learn more about when you joined M13, what were some core thesis that or core lessons that you've took from your per job to join the team? And when you're thinking about creating a venture fund, how do you think about what sector or what basically what theme of company to invest in, and I know that you specialize in commerce and work, and now many investors are very bullish on AI, and I wonder what's your thought on the future of the commerce and AI space in general, and what is M13's approach on investing in these companies? What is the lens that you guys use to evaluate each company in this sector?
Yeah. So it's a bit of an evolution. I'll first answer sort of a little bit about our investment thesis and how we arrived at that. And we talk about it all the time at M13, which is we invest in the startup and venture landscape and founders that are starting new businesses and extreme innovation going on every few years. What I was looking at as a VC 3 years ago, largely a lot of those business models are out of date. And now it's AI, and now it's something new. And so every few years, things are changing very, very rapidly. And we go through foundational cycles that are very impactful, going back to early 2000s, the early internet, people adjusting to buying things online. And then we got to more of the cloud and software wave. And then we got to the mobile wave. And now we're at an AI wave. So there are these huge cycles that go through our industry. Long way of saying it's incredibly innovative and disruptive. And to think that VCs shouldn't be the same is kidding yourself. If you're not innovating as a group and continuously thinking, where are things going over the next 5 to 10 years, you're going to be left in the dust. And so with us, our investment thesis has evolved. When we first set out to raise our first fund, when we were, this was 2017 timeframe, we started investing out of Fund 1. It was all about that changing ecosystem in e-commerce. There were a lot of direct-to-consumer brands that were coming of age, getting quite large because they had started several years earlier, and we invested behind D2C white spaces. We were very much focused on the consumer and where is the consumer spending their money today and over the next 10 years. So we invested in a lot of great consumer products like FabFitFun and Rothy's and Daily Harvest. Also some digital products like ClassPass and Lyft and Pinterest. And that was Fund 1. And by the time Fund 1 ended in 2019 and we were transitioning to Fund 2, it became pretty clear to us that business model wouldn't scale. it was becoming much harder to invest in direct-to-consumer brands. Spaces had become largely commoditized. The cost of acquiring a customer online, it was no longer differentiated for some of these businesses. I still think personally it's a strategy that makes sense for a certain size of fund, just given where consumer and CPG products exit. You can still have a really great fund strategy if you're a little bit smaller of a fund, but by the time we got to fund two and it was about a $200 million fund, it no longer made sense to us. But we looked at this. We looked at the data that would suggest, and I'll give you just an insight into the consumer landscape and commerce. In 2022, it was the first time that e-com sales reached $1 trillion in the United States. About 15% of all purchases were done online, so 15%, internet penetration. Over the next 5 years to 2027, that figure is expected to grow to a little over 1.7 trillion. Call it, $1.8 trillion. So over the next 5 years alone, there's going to be about $800 billion of new market creation. And up until 2022, throughout the whole history of e-commerce, 1 trillion had been created. So over the next 5 year alone, you're almost creating an equal amount of TAM that has been created in the history of e-commerce. And so we see that as an extreme opportunity to invest. Just it wasn't directly into brands anymore. And we started to see more of the rise of some of these e-commerce software, e-com enablement, they call them B2B SaaS businesses that are helping the rise of e-commerce as a sector. And so in Fund 2, we transitioned and started investing a little bit more in the infrastructure of e-commerce, the enablement layer. And we backed businesses in shipping like Passport. I actually listened to your podcast with Sophia the other day, and she's also an angel investor in Passport. It's B2B for international shipping. We invested in a business called Rebuy, personalized recommendations. We invested in Pietra, which is infrastructure for starting consumer product brands. So we saw the opportunity that the market was growing, and we started to back those types of companies. And then in 2021, when we started investing in Fund 3, it was a $400 million fund. That's when we really doubled down and started to see the rise of AI and started investing in AI businesses for e-commerce. We started to invest in marketing automation, just some of the things that were changing at an accelerated rate in e-commerce. So I've gone deep into sort of that evolution with e-commerce and how we've, as a fund, have evolved to be more B2B SaaS investors in the sector of e-commerce. We'll also invest in marketplaces, B2B and B2C marketplace models. But a lot of what we do now are B2B businesses because we see the rise of e-commerce as a sector. And that's one of 4 areas that we focus on at M13. The other 3 are healthcare, fintech, and future of work, which you noted I spend a little bit of my time in. But it's a long way of answering your question about thesis development. We're trying to see what's happening over the next 5 to 10 years. What can we get ahead of? You briefly mentioned AI, so I'll touch on that. We see it as a generational shift. The same as internet, mobile, cloud, now AI. It can possibly have much bigger impact than all 3 of those. And so we're looking at a lot of AI applications in commerce around, how are B2C businesses, e-commerce merchants going to advertise and acquire customers? How are B2B businesses going to market to customers more efficiently and improve their go-to-market function through a lot of AI tools? So we look at, I outlined sort of our 4 verticals: commerce, money, health, and work. And then underneath those 4 verticals or 4 pillars, we look at horizontal solutions like AI and how is AI being applied to each of those 4 pillars. We look at Web3 and blockchain technologies, how they're being applied to those 4 pillars. So there's a lot of things that we do at a horizontal layer to develop our thesis in M13. But that's just a little bit of where we invest and how we develop a thesis over time. Because I do think you really have to evolve as a venture fund. Otherwise, we're investing in an industry that evolves at the time. Why wouldn't we do the same?
I wonder when you were talking about the thesis, like there's a shift between like D2C brands to now you guys are investing in platforms or like SaaS company behind the e-commerce space.
Yep.
I wonder, how do you create like a system to create like a sustainable pipeline for yourself in terms of like getting exposure to the most I wouldn't say important deals or like the most like quality deals. And what's your evaluation on like what deal is quality? And in terms of like, you know, making investment, like we kind of like touch upon the portfolio construction a little bit like last time we chat, and I wonder like when you're thinking about portfolio construction, how do you like see each portfolio into place into their part for like to return the whole fund, or like, you know, how like I guess like how what's your thinking framework on that, and then how do you evaluate if um a particular company can reach a certain level of valuation?
Yeah, phenomenal questions. I think the second part, so breaking into more of the math, the portfolio construction, and then the second part is how do you evaluate? I think the second part is what all fund managers, all VCs need to refine and get good at over time, right? That's the $1 million question. How do you evaluate what's going to be a multi-billion-dollar outcome? And so there's a lot of things that we do that I'll touch on in a second. I think when you get to this place where now we're on fund three, eventually we'll be on fund four, and you become fund managers, the portfolio construction becomes a lot more important. You have to show to your stakeholders and investors, your limited partners, that you can build a sustainable venture practice that picks the winners consistently over time.
Mm,
And that's like the place that I think we've really seen our muscles exercise over the last several years, is becoming really great fund managers and understanding how to construct a great portfolio that can return many multiples to our LPs, how to get liquidity in that portfolio. So I'll touch on a little bit of portfolio construction. We're writing an article on this that'll come out in a couple of weeks. I'll definitely share it with you.
mhm,
But it just talks about venture math. And there's been a lot of articles I've seen over the last couple of years on venture math. And the takeaway is venture math is really hard, which is true. And I think part of the reason that I wanted to write this article was to dig down into why exactly the math is hard, but
mhm,
also highlight, to your second question, the more important thing: what do we do about it? How do you construct a portfolio where the math actually works in your favor consistently over time? And so for us, when we set up a portfolio construction, we at the beginning of a fund cycle, I'll give you an example of what we did with Fund Three. So Fund Three is around a $400 million fund. Before we even invested a penny out of that fund, we built an Excel model that showed, okay, this is our planned deployment. Now, it's never going to go 100% according to plan, but if you have a plan, you can understand where you need to deviate from that a little bit. And in that plan, we said, okay, we want to have 50% of our capital for first-time investments and 50% reserved for follow-ons. So about 200 million for each of those pools. And the second pool, 200 million for reserves, we have to be really, really strict and really, really careful with those dollars, because you only want to invest those subsequent dollars into your winners.
mm,
It's really hard to pick when that next round of funding happens, but that's a strategic part of the fund construction that can really drive returns. So we have a $400 million fund. We, as a firm, set a minimum return target of 3x net. So 3x net means we have to turn $400 million into $1.2 billion to return to our LPs. But that's net of fees that we take of the profits we give back to them. So in reality, it's more like $1.4 to $1.5 billion of returns that we have to send back to our LPs. It's really hard to do. So we take a $400 million fund, we build a model for M13. Our strategy is to have a really good balance between having enough shots on goal, so having enough portfolio companies that we're going to see exits from, but also in each of those having a high degree of ownership. Because if you invest in a $10 billion company and you only have 1% ownership, it's really not going to drive the needle in terms of returns as much as you would think. So we, in our Fund 3, our portfolio construction was have about 25 positions of 15% ownership each for that initial $200 million. Now, there is a concept in venture called the power law. right? There was a book written on it that's a really great one that we highlight in the article that just essentially lays out you can't escape the power law in venture, which is to say, of all the companies you invest in, the outliers or one, two, maybe three are going to drive the bulk of your returns for the portfolio. Now, every time we make an initial investment, we hope and we think that each one of those companies could be one of those one to three, but we know that it's only going to be one to three companies in the whole portfolio. So a lot of people in venture talk about a third, a third, a third. A third of your companies are going to probably lose most of your capital. A third of companies are going to return your capital that you invested, and then a third of companies you're going to have a decent return. Anywhere from a 3 to 100x. Let's talk about. And so we drill down and we understand we need to have a certain amount of ownership. So even of those, if you have a third of 25 positions, it's really only 8 companies that are going to return capital. If you have one that is 100x, you need to have enough ownership in that business to really drive the returns of the fund. And so we target 15% initial ownership. We factor in dilution by the end of the fund, meaning when subsequent rounds come along, by the time of exit, we might have 10%. If a company exits for $10 billion and you have 10% ownership, that returns multiples of your fund. If it exits for $5 billion, you can see where the math plays out. And so that's how strict we are about portfolio construction. We need to get high level of ownership in the first investment, and then over time, you need to really protect that ownership in your winners. And that is something that's really key of our portfolio construction. And I think the second part of your question, what do we do about it? How do we make the math work? We've broken it down into a couple areas that we spend a great amount of time on. So first is with the founding team. That is the most important. It's the first thing you see when you come to our website. We back extraordinary founders. We spend an extraordinary amount of time with those founders to understand, are they going to be one of those 1 to 3 companies that really have the right thing to take to the distance. We have our own proprietary founder assessment tool where we look at a number of different traits, some of which are they visionary, right? Do they really want to build something that is generational, something that has very, very high aspirations? So that's one. But another part of visionary is, can you bring on a great team, right? Can you be a salesman and land really great employees to join you in your vision? That is very, very key. Another attribute we spend a lot of time thinking about is persistence, right? When the going gets tough, are you not going to give up? Another one we look at is resourcefulness, right? Are you using everything to your advantage? Are you finding the right ways to win? Are you, just being resourceful and finding the winning strategy? And so there are a number of other attributes in that survey assessment that we look at that over the course of diligence with our founders, we're really trying to drill in. Are they going to be, one of these top positions and try to take it to the distance? The other thing we think about a lot is TAM and market, right? If you're really searching for a $10 billion exit, you can't be building in a $5 billion TAM, right? That literally just doesn't make sense. And so we have to believe that either one, the market is very large today, or two, there are extreme tailwinds why we think in the next 5 to 10 years, the market could see incredible expansion. That's, I think, a lot of what you're seeing with AI today. If you summed up all the revenue of AI in a lot of categories, it's not going to be very much, but you have to look out 5 to 10 years from now, and the level of adoption with some of these AI tools is staggering. And so where do we think the market size can be over the next 5 to 10 years? And we build our own bottoms up model and we make adjustments to those, and we just really understand the math of in the market, can it really support a 1, a 2, a 5, a $10 billion outcome? Then the other areas that we spend a lot of time on are, our unique model at M13 is very platform focused. We want to be there to provide extra resources to our founders. And if you look at M13, our team, there's about 40 people at the firm, only 10 are investors, which means 30 are full-time employees at M13. They're operators that are there to help our portfolio companies. It's a 3-to-1 ratio of operators to investors. Our signal to founders when we're meeting them is, this is what we want to bring to the table. In that team of 30, we have a 5-person talent recruiting team that helps you with everything talent related. We have a data strategy team. We have a go-to-market team. We have a product team. So anywhere that you might need a little extra edge as a founder, we just want to be there on a proactive basis and give you those resources. A lot of the companies we invest in, they're 10, 20, maybe 30-person teams. They don't have a lot of leadership in those roles. And until they get to that Series B stage where they can hire a few more people, it can be really impactful. And so that's where we found our edge is our propulsion team. And our propulsion team, going back to portfolio construction, you have a third, a third, a third. A third are going to lose money, a third are going to give back money, and then a third are going to generate your returns. We really think that our propulsion team can impact that middle third. If you can help companies avoid bad decisions, if you can help save some of those, those middle layer businesses, it's really impactful to portfolio construction. So we think it's a value add to our founders, yes, but going back to fund managers, I really believe that is going to help us drive a incremental decimal points on our net returns to the fund, because we're so into the deployment of resources for our founders and just helping them execute a little bit better. We're not taking over the reins. We're not telling them what to do. We're just providing them with resources that they otherwise wouldn't have. So that's sort of how we think about portfolio construction, and then our assessment in companies and making a decision to see if they're going to be one of those drivers of returns for the fund.
Totally. I wonder when you're thinking about investing in the commerce and AI space. So I know that M13 have 4 category of things for investments, right? So in terms of portfolio construction, do you guys split that into, let's say, 4 company or 6 company each category or something? Or or is it more generalized, as long as they fit into this theme, you would approach it? And then in terms of evaluating a certain deals, let's say when you're, I guess, would you write out a thesis on a particular subject? So for example, let's say using Pietra as a example, let's say when you're thinking about this deal, is this a particular thesis that you have developed before you meet this investment opportunity, or are you more opportunity driven? Let's say you have getting introduced to this team, and then let's say this is among the 50 deals that you've seen by recommended by other investor or something, and then you kind of develop a conviction after you meet enough founder to see this is a very special team. Yeah. Are you more on the thesis side, and then you're hunting down a particular type of company, or are you more of opportunistic, you just meet this founder, and then among the founders that you've met, this is a good one?
Yeah, good questions. On your first question about diversification, portfolio construction, we think about it, but more of a generalized approach, not a specific. We have 4 categories of investment. We don't split that into 4 equal parts, but we are conscious of it, right? If we're investing out of a fund and our first several investments have exposure to consumer wallet spend, right? And we can't have an exposure to, if there's a pullback in consumer spend, if debt spirals out of control, we can't be overexposed to that category. In the same way, if we're investing in, healthcare in a certain regulatory environment, we can't invest all our dollars there. So we do look at it on a quarterly basis as a partnership and understand where are we at in the deployment. If we break down our portfolio to date, where are our dollars going, in what categories do we need to be more exposed to a certain sector? So it's not necessarily formulaic, but we do keep tabs on it to make sure that we're diversifying across the portfolio. So that's one. On the second question of sourcing opportunities, and I'm going to give the easiest answer ever, which is both, or it depends, right? In that spectrum, we really do both. I think if we are thesis driven in certain sectors, and then we're very opportunistic about founders approaching us in those sectors. So what I mean by that is we all have there are 6 investing partners at the firm. We all specialize in a certain area. Like you noted, I cover commerce for the firm, a little bit of future work. My partner in LA, Anna, covers commerce as well. My partners in New York, Latif and Carl, look at healthcare and fintech. My other partners, Courtney and Carter, look at like food and food technology and marketplaces. And then Carter spends a lot of time in creator economy, just given his wife's network. And he looks at a lot of commerce as well. And so we have sort of exposure into a lot of our 4 sectors, and each of us has an area of specialty that we focus on. And we spend a ton of time just getting smart. I don't just talk to founders. I talk to people at Google and Meta. I talk to other investors. I talk to industry professionals and a lot of merchants and D2C brands, and understanding, where are they seeing white spaces in e-com SaaS. And so we spend a lot of time on that, is what you would call thesis work. And then we're very opportunistic about the founders approaching us, because we have developed a certain thesis or a certain level of expertise in that sector. So I can't say that we're only investing. Right now, I'm spending a lot of time in understanding where advertising technology is going over the next several years, because third-party cookies are finally in 2024 going away for good. And so I think the wallet share of where advertising dollars are going to slowly shift outside of search, which is Google, and social, which is Meta, and into new areas of opportunity. And so I'm looking at a lot of investments there. With that said, I'm not only going to invest in that category because that's where I'm developing a thesis right now. I might invest in other categories where in commerce, of course, where I find a really talented founder that has a particular point of view, and I believe in that point of view, and I can get behind that thesis. So we do a little of both in the thesis development, and then we're very opportunistic about great founders that are approaching us, or we're outbounding. We find them on LinkedIn and we cold call them. So we do a combination of both, but that's sort of our sourcing strategy, to be experts in a field and have particular points of view, so that when we do take those calls, we're able to assess, and understand, are you building the right place? When you pitch us a certain thesis, can we, ask you hard questions and understand if that's the right approach or not?
I wonder, I want to double click on, you mentioned that you're currently studying the advertising category of things. And I wonder, like, what were some insights that you found there? And like, I have a second piggyback question on this, which is like, when you are, let's say, studying an industry, or like getting some insights into a particular category, where does it start? Like, does it start with talking with, like you mentioned, like people from Google or Meta? Like, what type of people would you talk to? Would it be more like on a high level executive level to see a general trend, or would it be more of like younger people who are more on the ground? Like, how do you kind of like shape your informational diet to kind of shape your thinking on where the opportunities are in the investing ecosystem?
Yeah, I'll take the second one first, then go back to advertising. It is everybody that I can talk to. Right? I think everybody has a good point of view. We hosted a couple months ago. We hosted a breakfast in our office in Santa Monica for e-commerce merchants. There were about 20 e-com merchants there, and it was a very casual, informal breakfast. And we invited the head of growth from TikTok, and she talked a lot about advertising on TikTok, which is
Mhm.
seeing a boom as of the last couple of years. And then we specifically drilled down into TikTok shops, which saw extraordinary growth over the last couple of quarters. But there was a feeling from merchants in that room that it was all very randomized. Yes, you can point to some case studies of merchants that had seen really great success advertising on TikTok shops, and they had gone viral. But there wasn't necessarily a playbook. And it was almost like the TikTok algorithm, which surfaces the most random things to you. It seems like that is what led to a lot of success and early virality for a lot of brands. And so just being in that room for a couple of hours and understanding what merchants were really digging into to find out, how can we find a repeatable playbook to, have our brand see success on TikTok shops. I think they all think it's a great opportunity going forward, but they were trying to, get specifics on where they could, improve their strategy to advertise there. So that was a number of low level, high level e-commerce merchant founders, and then the head of growth for TikTok. And it was a great meeting. So I think those are some of the examples where we take industry professionals, bring them together with merchants in our network. I spent a lot of time talking to e-commerce merchants, very large e-commerce Shopify stores with hundreds of millions of dollars in sale to, the smaller starting out ones with a million or 2 million a year in sales, and understanding what are friction points, what are areas that are preventing them from growing faster, from having higher margins, from taking home more cash flow. And that's how I see a lot of opportunities to dive in and start a thesis. And so that was an area that I heard a lot of rumblings about it was about a year ago of, okay, third-party cookies are finally going away. We're going to have to finally deal with this. Where are we going to put our advertising dollars to work? And I started to dive into advertising, more ad tech, marketing tech for e-commerce merchants, and found some really interesting opportunities. I think a couple that came to mind, and these aren't, I'm not pumping up my own investments. These are just businesses that I thought had a really interesting angle on where the future of advertising were going. We met a business called TopSort. About six or 7 months ago, that was enabling marketplaces to turn on advertising revenue. And there's a great tailwind there. When Instacart went public, they finally unveiled the curtain and showed that a large part of their revenue, almost up to a third of their revenue, was from advertising dollars, where brands would have preferred or sponsored placement when you open the Instacart app. And that was, no one really expected, at least people that weren't covering the business really closely, that much of the revenue would be made up from advertising. You also see that Uber has a massive advertising business. And so this company, TopSort, was the infrastructure to set up your own ad network. We saw that as a really unique offering in the market. And then a few months later, we found a business in San Francisco called Fermat. And Fermat is e-commerce infrastructure for advertising to customers on Instagram, Meta, and they allow, whereas previously you would have an ad on Instagram, you would click on that ad, it would take you to the site, and then you would lose the ability to track the actions of your customer. And if they fell out of the funnel and didn't make a purchase, it was really hard as a merchant to understand what happened. Vermont creates the whole checkout experience in one app, and you're able to track what went wrong as a merchant to improve ads over time. And so those are just two examples of areas, we started to have an investment thesis and how advertising is going to change. When you're doing that, you're talking to investors, you're talking to entrepreneurs in SaaS enablement, you're talking to direct-to-consumer merchants, and they're constantly saying, oh, have you heard of this company? Have you heard of that company? And then we dig and we dig and we dig and we find more in the ecosystem. And so it's this evolving area where you're just trying to talk to as many people and get smart as possible. And then you'll eventually run into the right solutions that you want to invest in.
I wonder, when you are selecting one company out of a basket of similar companies, can you give us an example of when you mentioned, let's say you just mentioned like Firm, this company about the consumer infrastructure. So basically like they're helping they're helping the shoppers, not shopper, but like the small businesses to figure out which part of their ads went wrong. So for example, for that company, how do you come up with, so let's say if you discover there's like 5 players in the industry, maybe some are too late and then some are earlier stage, and how do you figure out like this is the investment opportunity for you? And when you're looking at the competitors, like how do you like figure out who is going to be the category winner?
I think I'll probably answer the question with a different company, just given I'll answer it with one of the companies we actually invested in, so you can see that whole process of how we came to find them, do the diligence, and then invest in the company. So a little over a year ago, we invested in a business called Rebuy. And Rebuy is in the e-commerce enablement space. It's a SaaS tool that sells to D2C merchants. It's an AI recommendation engine.
Mhm.
So I think the very best example I can give you is what Amazon does on Amazon's website. When
Mm.
you click on the Amazon app or you enter in their website and you're looking for a new product, Amazon's recommendation engine is everywhere, right? It's below the product page where it says customers also purchased these items. It's in the checkout when it says, don't forget to pair it with these items. It's in the post purchase experience.
Mhm.
And one thing that we were learning about Amazon during this rebuy process was that one single product, a recommendation engine, and nobody knows you better than Amazon, right? And it
Mhm.
has AI capabilities that have been fine tuned over the last couple of decades. That one product results in about a third of their marketplace revenue. So about a
Mhm.
third of all purchases made on Amazon Marketplace are through these personalized recommendations. And so we're like, this is a huge category. Rebuy is doing this for Shopify customers that don't
Mhm.
have that same ability to do what Amazon does.
Mhm.
And so we first started and we found the founders and they checked the box. They were incredible. Merchants loved them. The product seemed to work. We went through case study after case study of how there was a huge conversion uplift, a huge AOV uplift that made meaningful difference to the bottom line of Rebuy's merchant customers. And so then the topic of competition came up. And there were a lot of companies that had come before Rebuy.
Mhm.
Carthook was one, and there's a number of these smaller, lightweight players that made personalized recommendations. Even
Mhm.
Shopify has their own very lightweight tool to do that. But when we
Mhm.
came to understand in terms of the competition for Rebuy, and it's similar to the other companies we look at, is they really had solidified a data moat. At the
Mhm.
time we invested, they had about 5,000 merchants in their umbrella, 5,000 merchants that were paying them, that they had access to their user data and understanding where customers were adding different items to the cart, where they were abandoning cart. And so that data moat was a real differentiator for the business. And now, they're about double that. So they've doubled the number of merchants, and their
Mhm.
data just even gets more powerful. The AI tool that they had developed was much better than other brands. And the way we assess that is we asked, as part of this diligence process, we talked to about 25 people in the market, current customers of Rebuy, customers that had used some of their competitors, and everyone talked about how Rebuy's engine was much more powerful, much more accurate than the other competitors. And the way they described it is other competitors had very simple rules-based engines. If you add the sweater to the cart, we are automatically going to suggest that you add our best-selling item, a shoe. It doesn't matter who you are, your demographic, other items you added to the cart, we're always going to recommend that one
Mhm.
product because it's our bestseller. Makes sense, right?
Mhm.
Whereas Rebuy takes a more personalized approach. It knows that Grace is a different shopper than Brent. It knows that you've added different items to your cart than I have, and it'll recommend different things that are more that will make you more able to purchase an additional product. So we did a ton of competitor analysis, talking to the merchants that use them both, and assessed that these guys really had a lead. And then it became clear that in a lot of these e-commerce SaaS categories, whether it's reviews or SMS or email or personalized recommendations for Rebuy's case, there emerges a category leader where Shopify merchants that are of a certain amount or a certain size are always referring the same tools to each other. And Rebuy had risen to the top of that list, and everybody was referring each other to Rebuy because it did better than every other product. So those are some of the things that went into our decision to invest in the company. But we certainly had to look at the competitive landscape and understand, Rebuy has a lead now. Can they maintain that lead? And we do believe their data moat and their product team that just continues to build really great products for merchants is that long-term moat.
I wonder when you are thinking about, let's say, for example, when you are investing in Rebuy, like, as we previously talked about on the portfolio construction side, like, every company out of the 25 company should be able to like theoretically return the fund or have the potential to do so. Um, I wonder, like, in terms of valuation or like, basically, like, I guess, like, is there any particular evaluation that it's your cutoff line that's like make you decide like maybe this is not going to be worth my time and effort to do so? And um, is that like a big component of how you evaluate a business, or how like, or it's more of like, um, are they having the potential to go to into like $1 billion business in general? Like you don't care as much.
Yeah. It's a combination of all those things, a combination of valuation, ownership, and where you think the ultimate outcome can get to. And that's part of the deal decision process that I think really distinguish seasoned portfolio managers from first-time investors that are just focused on a great founder, a great product, building in a big market, which are, I would argue, the most important things. But you can't forget about portfolio construction and returning capital to your LPs.
Mhm.
So when we look at a business, let's focus on Series A. Series A is where we spend the majority of our time. It's about 80% of our dollars deployed are leading Series A deals. And then the other 20% are more seed stage. So in Series A, our average check size, in order to get to 25 positions, our average check size needs to come somewhere in that $5 to $10 million range. Sure, if we invest in a couple lower valuation Series A that we invest 5 million, then it gives us ability to maybe do an 11 or $12 million check occasionally, but we can't invest 25, $12 million checks. So we always have to think about portfolio construction. Does it come in that $5 to $10 million range? If not, then it has to be a 1 or 2 exception, which you can
Mhm.
be flexible in your model. You just have to understand that you'll have to compensate for it a little later on. So with $5 to $10 million, we have to buy 15% ownership. You can do the back of the envelope math on where the valuation comes to. Again, it can be a little bit higher valuation, and we can stretch that check size in certain circumstances if we feel like the upside potential is so much larger. So an example is if we're investing in a company where we do an underwriting and we think, yeah, we have a high degree of confidence that this business can be a $2 billion outcome. Again, a third, like more likely than not, it won't. But we can see if they execute and do everything right, that it can get to a $2 billion outcome. In order to be a $2 billion outcome, we have to have, in order for it to return substantial amount of capital to the fund, we have to have a good amount of ownership. So again, we model out 10% ownership at exit. $2 billion outcome produces $200 million in fund returns. If we're investing out of our current fund, $400 million vehicle, that returns half the fund. We have to do that again 7 or 8 more times to return a gross number that gets us to a 3x net number. So you see, as you go through the math, it gets really hard. Producing a $2 billion outcome is not very easy, and we know that. So we have to look at portfolio construction with a really close eye to understand that, can this company really get to that outcome? Now, there are certain categories that we invest in where we underwrite a $10 billion outcome. We're much more optimistic about where the business can go. Now, the higher the outcome potential, usually that means the more risky, right? The more headroom it has to go. And so the likelihood that it gets there is lower. But you can see a scenario where it exits for $10 billion. We don't necessarily need 10% ownership. Maybe we only need 5% ownership, and you can still have a massive fund return. And so it's some of those trade-offs that you think through when you're investing in a company, and you're really doing the underwriting in a very smart way to understand, okay, how much ownership do I really need to produce a significant amount of return for my fund? Because we want to continue to do that. If you don't focus on the portfolio construction, you don't raise another fund, and you don't get the opportunity to back the next generation of founders. And so it's all part of an ecosystem that I'm trying to convey with founders when I'm talking to them is we want to continue to back founders over the next 10 years, over the next 5 funds. So we need to think strategically about how we're setting up our fund structure.
Mm. How do you evaluate the process during the process? Oh, by the way, I want to say hi to LinkedIn user and Carlton. Thank you for joining us. Anyway, so um, I wonder when you're thinking about like one question is like about like how do you quickly evaluate throughout the process, because deploying capital for 25 companies throughout like this fund, it's gonna take at least over a year, or like 2 year or maybe 3 or something. So like I wonder throughout the period of time, how do you quickly evaluate if each portfolio is performing? And in terms of like updating LPs, I don't know how, if you're comfortable talking about it, or like maybe we could talk about like things on a high level. How do people like update LPs? How do people update each deal happens, or like do people update like quarterly, or like how does that reflect into the reporting process, as well as like a separate question is like, for example, do you guys have recycling percentage? And like, because you guys are a lot bigger fund than like most emerging managers or people that are having smaller funds, maybe those are on a different like level when it comes to like the thinking process. I'm just curious about like, how do you guys like run this set of things?
Yeah. So reporting is really important to our limited partners. We on a quarterly basis, we release our quarterly fund report. That's you have sort of your table stake stuff where you release fund financials to LPs, to the fund administrator, all of that. Then we want to make it a little bit more interactive. So we release, I think the last one was 50 pages of updates to the fund, new companies that we've invested in, new updates to our existing portfolio companies, what's going right, equally importantly, what's going wrong. And we have asks in that portfolio review where we say, we're looking for somebody in the network that can help our portfolio company with X, Y, or Z. We go through the numbers, where everything stands, what's our mark to market. We go through sector updates and industry updates to help educate some of our limited partners. So we do a really great job on a quarterly basis doing that. And then we host a quarterly webinar, and we invite all our LPs to join. And we go over about a half hour of running through the high level points of that doc, and then we leave it for question and answer. So that's what we do on a quarterly basis. On an annual basis, like most funds, we have an annual meeting where we invite people together to get together and socialize and meet each other for a full day. And we go over a little bit more some granular data on the fund and where things are going well, where things aren't going well. And we're really open and transparent to our LPs. I think on an ongoing basis, we have a really great brand and marketing team at M13. It's about 4 people that just help us get the word out of what we're focused on at M13, new investments that we've made and why we made them, what our thesis was behind, distributing that on LinkedIn and Twitter or X now, excuse me. And all the areas that we can market as a fund to help not only LPs, but other people in our network, what we're up to and what interesting thesis we have. We regularly write updates to our investment thesis and new areas of thesis development that we're working on. So we do that, more inside with our LPs on a quarterly basis, and then externally on an ongoing basis with marketing materials. We just like to give people an update of what we're up to. So that's on the fund reporting. What was the other part of your question?
Like recycling.
Yeah, recycling. This is a great point. And again, I'm prefacing a lot that's coming out of this article in a few weeks, but we also talk a little bit about recycling and the importance of recycling. There's a lot of articles, a great one by Brad Feld, another one by Sapphire Ventures, where they actually give you a model to help you understand the impacts of recycling. But if you remember back to the fund math, $400 million fund returning 1.2 billion net to LPs means you have to return 1.4 to 1.5-ish gross return to LPs. So again, $1.5 billion of returns. If we do not recycle, we are taking a $400 million fund and stripping out, call it 60, 70 million dollars of management fees to run the fund, which over the course of 10 years. So instead of taking 400 million and producing 1.5 billion, really you have to take 330 million or 340 million and produce 1.5 billion if you do not recycle. So you can imagine that the amount of capital you have to earn back from that limited amount of capital is much, much more. So we like the idea of putting all of the LP's money to work, and we plan to recycle up to 100% of management fees. So instead of investing 330 million to return 1.5 billion. We're looking to invest 400 million to invest 1.5 billion. Still hard, but it is a much harder math equation when you do not recycle. And so that's something that we really think hard about, a part of our portfolio construction.
Mm. I was reading this like article the other day. So, one of the earlier stage fund manager was saying about like consider the ratio between entry ownership and the fund size. When you are like when you're investing, I think like I guess like at what ratio would you want to keep throughout to like basically to like I guess, like, how do you, like, control the ownership of, like, each portfolio? And that's it, like, are you trying to do the same percentage for each company? And, uh, what do you see on, like, the, ownership side?
Yeah, we listen. Dilution is real, and it significantly affects fund returns. Um, there's always when you hear about a fund or a VC in a really great outcome in a company that goes public or a company that's acquired, that's fantastic to be able to get into that deal. But it's also really important to understand what was the ownership, because that is what is going to drive fund returns. And if you have a $1 billion outcome, if you have a unicorn that sells and you have 10% ownership, that's $100 million back to the fund, right? If you only have 5% ownership, it's $50 million. If you have 15% ownership, it's $150 million, right? So there's a big swing there. It's more important the larger your fund is. If I'm investing out of a $50 million fund, and I have 5% ownership in a unicorn, it's fantastic. That's a fund returner. That is incredible. If I have 5% ownership and I am a $400 million fund, that returns 1/8 of my fund. And in order to get to a 3x fund, I need 25 of those. How many funds can you point to that have, in a single fund, not even a venture firm, a single fund have 25 unicorn exits? It's not happening, right? It's non-existent. So ownership becomes very, very vital, which means we have to be very stringent and strict. We've now become a $400 million fund and we lead Series A. If we're not in that lead position, we're not getting the ownership that we need. And it might be a great company and we're really happy with the founders if they want to accept another term sheet. But I cannot look my LPs in the eye and say I'm investing in their portfolio or their money wisely if I sort of tack on to that round, invest a couple $1 million, get 3% ownership, and count that as one of my 25 positions, because I know at the end of the day, when that company exits, you're just not going to return enough capital. And again, not saying anything against the founders or anything like that. Could be a really great outcome, but that is part of the equation that you really need to understand. And dilution is really, really important. We just we did a case study with our investment team the other day on the Loom acquisition. And Loom was acquired by Atlassian for almost $1 billion. It was a really great outcome. And they didn't raise a ton of rounds, but they ended up raising about 200 million of capital. And we did the analysis. Series A investors made about an 11x return from that investment. And if we were investing out of that at M13, 11x return would have returned about $130 million to the fund. So that's great. It's a great outcome, but it only returns a third of your fund. You would need to do that several more times in order to have a 3x net return. So those are some of the things that, as you become more of an experienced manager and you have more portfolio construction to think through, you really need to understand the impacts of dilution. And that's why I said at the very beginning of this podcast, the reserves allotment is incredibly important. We have 50% of our fund just for reserves. And so when our big winners are raising subsequent rounds of financing, and we have 15% ownership, we want to maintain 15% as long as we can. Now it gets to a point where valuations become way too high and it doesn't make sense for our fund size. And so we sort of stop investing our follow-on. But hopefully at that point, they're raising such large rounds at higher valuation that the dilution to us is minimal. And we can still be in a place where on average, 15% ownership only gets diluted to 10% at exit. and we can have some really good fund returns that way. So that's just how we think about maintaining the ownership, and dilution is a really big component of that.
I have like one real question and then one quick 1 minute fire round. I don't know how long you have, but I will try to
Yeah, go ahead. Yeah.
quick. Okay. So one of the real question is like, people's advice for like new fund manager is like pick a portfolio construction strategy that maximize your edge. What do you think is M13's edge? And then why do you guys pick this particular fund construction strategy? And like a comma, there's like a half question is like, some people suggest that like models should be like optimized throughout the fund cycle. And I wonder like if the optimization strategy for you guys is like just to stay with the strategy, or like what's your kind of like learning on currently deploying, not deploying, but like executing out on this strategy.
Yeah, I think we've definitely evolved the strategy from fund to fund.
Mhm,
Again, I think you need to be flexible in your portfolio construction, but really, you discussed it earlier. A fund deployment period is like 2 to 3 years. That's on average sort of what we do. In two
mhm,
to 3 years, not that much is changing. Maybe you can make an exception for AI and how that has disrupted our market in the last year alone. But for the most part, we stick to a consistent strategy, fund to fund.
mhm.
So we have a portfolio construction model, and we can be flexible with that, but we don't really break the model and tear it apart and start on something new in that 2 to 3 year period. From fund to fund, certainly, right? We started investing at M13 at 2017, and it's 2024, so we're going on about 8 years of investing together. We should probably change our strategy as fund sizes grow. So one thing unique to our model is there's been a ton of analysis on this. Horsley Bridge is a really great institution that's put out some numbers on this. I was just listening to a YouTube clip from Top Tier Capital, one of the larger fund-to-fund investors, that did some analysis on fund size and returns. And they talked about, that 0 to $200 million fund, that stage produces the most amount of higher fund returner type of funds. So on average, the top quartile in those funds is above like a 3x net return. And then as you go from 200 to 400 million, it starts to go down a little bit more. And then as you get to the mega funds, over a couple $1 billion, you're really not looking for a 3x net return, because it's just really hard to return $10 billion of capital. But you see a taper off kind of around the $400 or $500 million mark in terms of a fund return. And we always want to return 3x to our LPs. So that's kind of a reason why we stick with that fund size. We think with 400 and the investment team that we have and our propulsion arm, we're able to consistently drive 3x returns through that fund size. And then again, like we really rely on our propulsion model to help us attract founders that want a little additional help, that could use some additional resources, and that can help them along the way. So that's our model in terms of attracting founders so that we can set up our portfolio construction the right way. So that was that. And what was the second part of your question?
So like, yeah, I think, yeah, does the fund model so some people suggest fund model should be like optimized throughout a fund cycle. And
Yeah. So we do, halfway through our fund three, we've looked at it and said, are we getting the right ownership percentage that we need, or are we not? And do we need to change our strategy? So we're always calibrating in that initial fund portfolio construction model about where we need to optimize. Should we try to get a little bit more ownership? Should we diversify the portfolio? So yeah, we are looking, on a monthly basis. We get together as a partnership and talk about where we're going to optimize it. But yeah, I think it's a very different strategy for a $50 million fund, for a $100 million fund. There's a reason that those smaller funds typically perform better on a multiple basis, right? They're returning a higher multiple to LPs, maybe not as higher of a quantum of capital like we're doing with a $400 million fund, but they might only need 5% ownership of a $500 million exit, that gets them, a $25 million return if their fund size is $30 million. That totally works for their portfolio construction. So you need to understand where you're playing in the ecosystem, how much ownership you can get, but it's really hard to be a tiny fund and only get a half a point of ownership in a lot of these businesses and expect to return amount of capital, because you could have 4 or 5 really good outcomes, but in terms of capital return to the fund, if you don't have enough ownership, it really doesn't matter as much. So yeah, when I talk about portfolio construction and strategy, it's very specific to our $400 million fund, which was different than our $200 million fund, which was different than our $90 million fund one. So these are all parts you have to take into consideration when you're building a fund.
Amazing. I want to end with like a 30-second fire round for you.
Cool. All right, let's do
So,
it.
what's your favorite book?
Favorite book. I just read Dune and I love that. So that's top of mind right now.
Who would you invite to your dinner party?
Um, I would think, who's a good one? Probably Sam Altman right now.
Who made the biggest impact in your career?
Definitely the fund managers at University Venture Fund, Tom and Peter. They set me on a path that I'm forever grateful for.
Where can we find you outside of work?
I live in Pasadena in California, and there's a lot of great mountains out here. So I like to be outdoors and hike. Like to exercise. I often do workout classes with my founders and other investors. I love to read. You find me in my armchair reading all the time. So those are, people give me a hard time at the firm, but I love like sugar and carbs, and a pastry shop. Tartine in Santa Monica is like my favorite place. Obviously, the original is in San Francisco, but that's probably where you'll find me most days.
Amazing. Well, thank you so much, Brent, for coming on the show today.
Yeah, thank you, Grace. Great questions, and appreciate you having me.